Hi there, everyone. Welcome to another Ainslie's Gold Silver Standard Insights. My name is Joe, and this is where we break down the morning's news posted on ainslieBullion.com.au. Joined as always is Chris Tipper. G'day, Chris.
G'day, Joe.
And joining us today is Tim Kent from Kent Private Wealth. Kent is a certified financial planner, having completed both a diploma of financial planning and certified financial planner courses at Deakin University. In addition, Tim holds a Bachelor of Social Science, majoring in psychology from Bond University, has been in the financial services industry since 1999, has a wealth of knowledge. G'day, Tim. How are you going?
Good, thanks, Joe. How are you?
Very, very well. Of course, we want to make sure in this particular episode, and as we do say, pretty much always when we're talking to someone in regards to financial services type of things, the information that you're going to provide today is of a general nature only. Of course, it doesn't constitute, financial or taxation advice. My understanding is you're licensed by Syrah Group. Basically for the viewers out there, do your own research, of course. So basically NFA, not financial advice. Chris, I'll bring it over to you. Go for it.
Thanks, Joe. If you want to bring up that article from today, another day, another discussion about where we are in the cycle right now.
Yep.
We have inflation in the Eurozone coming in higher than expected at the same time as employment figures out of the US rapidly weaken, warning of a recession. So we've discussed on Insights previously that the US is likely already in a recession. And indeed, if we were using the traditional measures of 2 quarters of negative GDP growth, then we are. But these are unusual times, resulting in the need for changing definitions, apparently. Regardless of the semantics, however, we're clearly caught between 2 equally powerful forces, with raging inflation and rapidly slowing growth, both pulling in opposite directions in terms of how governments and central banks will need to respond, which is why there is so much debate in the analysis right now. Opinion seems to be about as divided as you'll ever see in terms of what comes next. I know I'm certainly having debates with everyone at the moment, and we seem to always be on opposite ends of the spectrum. So I don't necessarily disagree with the assessment from Grantham or Crescat, which was outlined in the news today, that things are looking pretty bad as the final deflation of the Superbubble, as that's what they called it, as that comes to pass, leading to carnage in the markets ahead. My problem is how you position for what these markets actually end up doing in response. It's pointless, in my opinion, to be able to say, look, I was right, I knew this would happen, and still take heavy financial losses, because even though your thesis was correct, the market moved in a different direction. You simply, there were additional factors you simply didn't take into account that can lead to an outcome that you weren't expecting, even if you were right. So that's what I'm concerned about here. You can be mostly right and still lose money if you're not paying close enough attention to what actually is happening, as opposed to what you think should happen. So that's why we're so lucky to have Tim with us today. I have so many questions as I try to get my head around all of the possible outcomes here and attempt to assign some level of probability to each so that I can position myself accordingly. So Tim, from you, really the first thing I'd love to know is, what's your big picture read of where we are right now? And in terms of my uncertainty dilemma, should people in fact be doing anything at all?
Yeah, look, you made some good points there, Chris. I think the way you articulated the drivers in the market and how uncertain things are, and really trying to work out what's going on, because there are positives in the market in regards to, well, you could argue balance sheets of companies in Australia are quite good, overseas as well. And also the consumer, there are elements that are in the global economy and also Australia consumers that are actually got a lot more cash than they have before, but obviously there are some that are doing it difficult. So broadly speaking, we're sort of, for the first time in, like I said, we've been doing it for 20 years, first time for a long time, we're very, very defensively positioned. So we've got a pretty big allocation to fixed interest. And that's, bonds are generally seen as being not a great place to be because of rising interest rates, but we're sort of believing that rates are sort of peaking out around here. So I think in the short term, if you're a trader, you might be able to trade the market for the dips, and then buy the dips and then trade it when they pop back up. But I think in the medium to long term, I think we're sort of standing aside from that and not trying to get involved too much. We're sort of picking out, there might be high quality companies, we might put a little bit of a small position in those. And if they fall, but high quality that have come off a bit that we want to, like, might be resource companies, and then just sort of use any sort of weakness, because we think over the medium term, long term, they're going to be a good place to be. So use that as a chance to sort of add or sort of start. But predominantly we're in fixed interest and cash and gold and a healthcare stock, a little property stock, and a little bit of mining, and a bit of energy, but at a small level. So I think broadly speaking, I think the market will trend down. I think the major sort of which the market needs to adjust for is that earnings are going to fall, and what multiple you put on those earnings, and obviously based on where the bond yields are at. So obviously a lot of moving parts, but I think earnings have to be cut in the US more because the macro is getting worse, and you've obviously got the interest rates. The interest line, a lot of companies also is getting higher. But yeah, broadly speaking, earnings got to come down, and then the market will need to decide what multiple they will put on that. So I mean, I think the bottoming process we believe will be later this year, maybe early next year. All depends how nasty or things turn, because they could turn into I don't know about a GFC, but there are parallels being used, as you may have been reading, to the GFC. Whether that happens or not, the crisis being in the energy space, and obviously inflation, the sovereign risk in the poorer countries of the world, if they have major issues due to inflation, unrest, and there is history showing that high inflation in poor countries can create a lot of unrest, and that can feed globally, a bit like the financial crisis, where you have those countries going under, and then that has a rippling effect through the financial system globally. That's a dire outfit, but that if that plays out, and that I suppose while we're positioned in the gold as well, if something does happen and play out that bad. But generally, if that can be avoided and inflation comes off, then as a result of that, then you'll have earnings come down, and then you should be able to move forward. But that's I suppose the Goldilocks. The Goldilocks, I suppose, is that earnings sort of the market looks through, and then you have interest rates come off, or the bonds come off, and the market moves forward. So yeah,
I think you've really captured my dilemma absolutely there, because there's so many moving parts, and to pick where we end up out of that, that's what's doing my head in, because every day you're sort of swinging back and forward as depending on what you read. Often, okay, this element is more important, this element is now more important, and you're swinging back and forward on that spectrum. So I think it makes a lot of sense.
Yeah, even being defensive, how we are. I mean, that's stressful as well. You worry of missing out, and then when there's a bad day, you're sort of happy where you're positioned. But there is, and that's where I suppose bonds have worked okay, because when the market rallied recently, it's because they haven't done as well as the market, but it's because bond yields have come off. So therefore, the bonds will rally, but won't as much as the market. So there's a bit of that playing out. Well, we're trying to position for that, so you get a little bit of uptick when the market ticks, because that's the only reason why it's rallying. That bounce off the low was because the 10-year came off. Yes.
So like I've been having that argument with people as well, that really even being on the sidelines is a trade in a way, isn't it? I mean, you're effectively making a decision.
Yes.
So it's everything's a trade one way or the other.
That's right.
Just to change the topic slightly, but obviously a lot of this is being driven by the Fed. And it's certainly something that I'm talking about a lot, and that people are interested in. Do the Fed even know what they're doing here?
Yeah, it's a good question. I think that if you go on Twitter, I think a lot of people, a lot of financial commentators are saying the same. I think, given the Fed was obviously behind the curve, they admitted that, so that's not anything. Well, anyone's come out with anything new by saying that they had that behind the curve, or they had no idea. But I think they know what they're doing now. I think they're obviously raising into a slowing economy, but I think they're doing that deliberately, because I think they understand. I think their argument would be, so I think at the moment they do. I think at this point now, I think they know what they're doing. I think 6 months ago probably didn't know what they were doing. They were behind the curve and thought everything would just sort itself out, and it obviously didn't, as in from an inflation perspective. So I think now they do know what they're doing. I think they are trying to hurt demand, and as a result of hurting demand, I think they are trying to get inflation down, and as a result of that, therefore not have to raise rates as much. And I think they are jawboning deliberately to try and cool demand, to sort of probably scare some consumers off, so that they don't have to raise as high as they do. So So I think at the moment, I think they do, and I think their objective is to slow the economy and get inflation down for the greater good, because long-term inflation definitely obviously helps to lower economic, lower to middle class. They get affected significantly, and that's obviously a bigger part of the economy, and that's something that they need to be aware of from a political perspective and also from a human perspective.
Absolutely. And an argument I've been making is that political perspective is going to become increasingly difficult to do if they have to actually raise the rates. So I suppose that leads very much into your jawboning comment. If you can get away with it without actually raising the rates, that's the best of both worlds, but pretty tricky line they're trying to navigate there.
I think if they I think if they do back away and don't raise rates because of the fear of causing a recession, I think that can create an even bigger problem, because inflation obviously keeps going, and then they have to, and it happened, like I said, the 70s, and I think they're fully aware of that now. You can see them talking every day that they're going to keep raising, because I gather they don't want to make the mistake of potentially, but I think you're right, politically it's going to become painful. But at the moment, unemployment's low in the US, so there isn't a lot of the political pushback. I think the political pushback,
it comes if those numbers keep dropping, doesn't it? That's right.
That's correct. If they stay, and that's what I'm saying right now, it's actually okay politically, because inflation is the major concern versus getting a job, and therefore let's target that and get inflation down, because that's more. But if they start losing their jobs, then it becomes much more difficult, I think, for them. Yeah.
So what I was going to ask is, along that line of thinking, a lot of our viewers will be interested in gold, silver, and commodities generally. What's the play there? How do commodities fare if the markets do plunge? What happens if we have a bit of a sell-off here? Where do you see commodities in that scenario?
Yeah, I think in that article today, it talked about how they thought that commodities are the place to sort of hide in, and I didn't know they were referring to, I think that's when you started off the chat, where they're talking about gold and silver. But if they're talking about sort of more copper, oil, I think that has to come down. So I don't think you can own those and avoid a plunge in the market. But I think so. I think the way it will work would be a plunge in the market would be then a move towards safety, and that therefore gold will get a bid, and then there's the chance that they will. So we've got it in the portfolio because, and we've been, I suppose the gold in Australian terms has been okay. If you had an unhedged option, it wasn't going that great. But in a hedged option, an unhedged option, it's been trading quite well. It's been, like today, it's been acting as a defensive in the portfolio. So it's there for, like you said, if the market does plunge, I think then market money would go towards gold. And I think then the Fed would have to take notice, because asset prices are falling. So that's inflation should be, historically it goes down whenever there's been a plunge, GFC, COVID, we have a deflationary type environment. So then that starts to kill that. So then the market would think they're going to have to, they can pivot, not have to, they will be able to. And as a result, then gold will run on the back of that. So hedge against sort of a plunge, also a hedge against anything dramatic where, a Chinese bank, well, there's obviously one fell over the other day, but if we have a financial system, and that's, and obviously we didn't talk about at the beginning, inflation's there, but China is dealing with a bit of dislocation there. And if that gets much more severe, then I think gold gets a bid. So I think at the moment, in Aussie terms, it's doing what it's supposed to do. It's been providing a hedge, has been acting as a market falls, it's been going up. So it's been doing what it's supposed to do in the portfolio with the sort of, I suppose, the optionality that if the market does go in a major downturn or a sort of a fall towards maybe 3,000 or a major fall, it will start to get a bid then, because the 10-year will fall and then the pivot will be on, I think, at that point. So I think pivot, everyone talks about, they say they pivoted before, and I couldn't really understand the bounce back, but it was probably because it was oversold. But I think the pivot comes when there is a major pullback, and then not from them talking about it. I don't think they'll talk about it until they're forced to, and not forced to, when they can, when the door opens for them to do it, and that will be the market falling in a big way, and therefore inflation should come out of the system because commodities, industrial commodities will fall.
And I suppose that's what, when you were talking about that there, that's the beauty of gold and silver when you think of them as a commodity, because obviously when you talk about industrial commodities or soft commodities, they can operate quite differently. But sometimes and it mentions this in the article, you get a little bit of a bet both ways from the industrial use angle, but also from the protection angle for
that's
protecting
right.
against plungers. So it's an interesting one to have in there.
Yeah, and it's also missed. I suppose it's not when the market's moving up. It sort of doesn't really do much, but it should be seen as a bit of a hedge at the moment with the call option. I suppose it's more of a call option when things do eventually adjust, or I suppose inflation comes off. But as a gold investor, I suppose it has been frustrating. If you look back to the 1970s, historically, I think a lot of gold investors are frustrated with inflation, that people aren't going towards gold, but it's probably acting like it did prior to inflation back in 2018 and so forth, where it was struggling. But when they pivoted in, the end of 19, gold went on a big run because they cut rates and stuff. So, yeah.
Well, maybe that's a sign of things to come. And we'll tail end it with that. Did either of you have any further questions or anything that you wanted to discuss?
No. I'd just like to say it's great to have you on here, Tim, and we'd love to have you back because you've got clearly a lot of insight into the sorts of things we'd love to talk about. So it'll be great to see you again on the show.
Thanks for having me. Thanks, Joe. Thanks, Chris.
Not a problem. Thank you so much. And I'll always end it by sharing the screen here. And we're going to give, as of course we should, a quick plug for Tim's Kent Private Wealth. So Kent Private wealth.com.au if you're interested in getting some kind of financial planning advice. Give them a call or an email, etc. Contact details will be on there, kentprivatewealth.com.au. Now, if you want to continue this discussion, we're going to upload this video this afternoon. That's Thursday, the 1st of September, 2022, in the afternoon, as soon as humanly possible after recording this, around about your 3 o'clock kind of mark. We're going to post that on Discord. Now, that's discord.gg/gold, discord.gg/gold. And we're going to continue the conversation. Chris, possibly Tim, possibly myself, will be on the Discord channel and we'll post this video and then we'll continue the discussion. We've got a great group of like-minded individuals in that Discord group, so it certainly pays to be a member over there. It's free to join, of course. And we'll be doing that this afternoon. Of course, also, if you're interested in bringing your two worlds, if you're into, say, the cryptocurrency side of things and you're also into precious metals, have a look at goldsilverstandard.com. That brings gold and silver into the digital world. We always like to do a quick plug for that. And of course, the morning's news at ainsleyBullion.com.au. And this is what our GSS insights are based on every single day, Monday to Thursday. That is, thank you so much once again, Tim, for having us, for being on the show. And we would love to have you on again. As always, thanks, Chris. And as always, as we say at the end, balance your wealth in an unbalanced world. Take care, and we'll speak to you soon.